Everyone talks about compound returns as if they were some magical piece of knowledge that changes your life overnight. But when you actually start investing, something very different from what you were told happens. 6 months later, you look at your account, and the growth is almost embarrassing. A year passes, and the needle hasn't even moved. 2 years are up, and you start wondering whether all those finance experts lied to you. Meanwhile, you're watching the people around you. They're buying cars, going on vacations, living their lives right now. You, on the other hand, are doing the supposedly right thing, investing for a future that feels impossibly far away. This gap between what you imagined and what you're experiencing creates such an uncomfortable state that you lose motivation for anything. Because here's what nobody tells you: compound returns are designed to feel like they're not working. The very mathematics that eventually makes people millionaires is also the reason the first few years feel like a pointless waste of time. Understanding why this happens and, more importantly, knowing exactly when it changes, is the difference between quitting right before the breakthrough moment and actually building the wealth you're capable of. There's a framework called the 7-5-3-1 rule. This framework explains not only why compound returns feel slow, but also exactly when they start to accelerate and what you need to do to make sure you're still in the game when that acceleration arrives. The moment you understand this system, your relationship with investing changes from top to bottom, because you stop measuring yourself against unrealistic short-term expectations and start seeing what trajectory you're actually on. Now let me explain to you clearly exactly how this works. The first number in the 7-5-3-1 rule is 7. And it indicates the minimum number of years you need to stay invested before compound returns start producing results that feel meaningful. This isn't an arbitrary number thrown out casually, it's backed by nearly 100 years of market data and points to a fundamental truth about how wealth is actually built. Look at what happens when you put money into a diversified portfolio earning roughly 10% annually. That's a figure close to the S&P 500's historical average return going back to 1926. In its first year, a $10,000 investment becomes $11,000. That's $1,000 of growth. It doesn't sound bad, until you realize you could earn that with a few extra shifts at any job. The opportunity cost feels enormous, because you gave up spending that $10,000 on things you actually wanted, and all you got in return is $1,000 you still can't touch. In the second year, your $11,000 becomes about $12,100. In total, you've earned roughly $2,100, but it took a full 2 years. Meanwhile, inflation has already eaten away some of that purchasing power, and the things you wanted to buy 2 years ago are now far more expensive than the day you started. The math technically works, but it doesn't feel like it's working. In the third year, you're around $13,300. In the fourth year, roughly $14,600. In the fifth year, roughly $16,100. 5 years of discipline, 5 years of watching others enjoy their money, 5 years of trusting a process that has given you nothing life-changing, and all you have is roughly $6,000 in gains accumulated on top of your original $10,000 investment. This is exactly where most people quit. They look at 5 years of sacrifice and see returns that don't justify the emotional cost. They conclude that compound returns are something that works for other people, people who start with more money or who got luckier in their investments. They pull their money out and spend it on something tangible, something they can actually enjoy right now. And then they miss everything that comes after. Because here's what happens in the 6th and 7th years: the acceleration begins. Your $16,000 becomes roughly $17,700 in the 6th year, and $19,500 in the 7th. You've nearly doubled your original investment and, more importantly, you've crossed a psychological threshold where your annual gains start to feel serious rather than trivial. But the real magic happens after the 7th year. Between the 8th and 12th years, your account goes from $19,000 to roughly $31,000. Between the 13th and 17th years, it explodes from $31,000 to about $50,000. In the 20th year, that original $10,000 investment has become roughly $67,000, and you made no contributions beyond the starting amount. The compound curve isn't linear, it's exponential. And exponential curves are deceptive, because they look almost flat for a long time before suddenly shooting upward. The 7-year mark is roughly the step where the curve starts to visibly bend, where your gain in a single year exceeds the total gains of the first few years combined. Historical data supports this timeline convincingly. When you look at 7-year rolling periods in the S&P 500, there has essentially never been a period where investors experienced negative returns provided they stayed invested for a full 7 years. Short-term investing is gambling. 7-year investing is wealth building. The second number in the 7-5-3-1 rule is 5, and it explains why even people who understand the importance of staying in for the long run fail so often. 5 represents the minimum number of different investment categories you need to spread your money across in order to be sure you're actually capturing growth, rather than hoping you picked the right thing. Most people who start investing make a critical mistake: they put all their money into whatever has performed best recently. Maybe they heard tech stocks were flying and bought only tech companies. Or they read that small cap value stocks outperform over time and piled everything in there. The problem isn't that these strategies can't work. The problem is that no single category consistently outperforms across all market conditions, and concentration leaves you exposed to devastating losses at precisely the moment you can least afford them. The 5-category framework proposes this. Large-cap quality stocks, value-oriented investments, growth stocks bought at a reasonable price, mid- and small-cap opportunities, and international or global exposure. These 5 categories behave differently under different economic conditions, which means that when one category struggles, the others often compensate. This matters enormously for the psychology of long-term investing, because the biggest threat to your wealth isn't market downturns. It's your own behavior during market downturns. If you're concentrated in a single category that drops 50%, you're far more likely to panic and sell at the worst possible moment. If you're spread across 5 categories and your overall portfolio drops 20% while some parts hold steady or rise, you're far more likely to keep your discipline and stay invested. Diversification doesn't maximize your return in any single year. It maximizes the probability that you're still invested when compound returns start to accelerate. The stock market's average return is roughly 10% per year, but actual returns vary wildly from year to year. The S&P 500 returned roughly 26% in 2023 and about 25% in 2024, following -18% in 2022. Individual categories experienced even more dramatic swings. Diversification smooths out these swings just enough to keep you invested through the volatility. And that's precisely what determines whether you'll capture the long-term average return or abandon ship during temporary declines. The third number in the 7-5-3-1 rule is 3. And this is perhaps the most important of them all, because it addresses not just mathematical theory but the psychological reality of investing. 3 represents the 3 distinct emotional phases every investor experiences, and understanding these phases in advance is the difference between surviving them and being destroyed by them. The first emotional phase is disappointment. This happens when your investments deliver returns that are technically positive but feel inadequate relative to your expectations. You invested $10,000, you expected to feel rich. Instead, you earned 7 or 8% in a year when you heard your coworker's crypto investment tripled. The returns are working, but they don't feel like they're working, and this emotional disconnect creates real disappointment. The second emotional phase is irritation. This emerges when your portfolio appears to be treading water for a long stretch, delivering returns so minimal that they make you question whether investing was worth it at all. Maybe the market went sideways for 18 months. Maybe your balanced portfolio returned 3% while a single stock you didn't own returned 40%. The irritation phase makes you angry at the process, at the advisors who recommended it, and at yourself for following conventional wisdom instead of taking bigger risks. The third emotional phase is panic. This is the most destructive one, and it emerges when your portfolio actually loses serious value during market downturns. Panic doesn't feel like disappointment or irritation. It feels like watching your financial future evaporate in real time. Every day brings worse news. Every look at your account balance confirms your worst fears. The rational part of your brain knows markets recover, but the emotional part screams that this time is different, that you need to get out before you lose everything. The panic phase has destroyed more wealth than any market crash in history, because it makes investors sell at the absolute worst moment and turns losses that would have recovered had they done nothing into permanent ones. The 2008 financial crisis, the 2020 pandemic crash, the 2022 bear market, each of these events witnessed countless investors selling at the bottom and watching the market recover to new highs within months or years. Market corrections of 10 to 20% happen almost every year. Larger corrections of 30% and above occur roughly once a decade. These aren't anomalies, they're the expected price of capturing long-term returns. Investors who internalize this reality don't panic when corrections happen, because they've already accepted that temporary losses are part of the deal. The fourth and final number in the 7-5-3-1 rule is 1, and it represents a simple commitment that dramatically accelerates wealth building. Increase your investment contributions by at least one meaningful notch every year. This might mean adding another 10% to your annual contribution when you get a raise, or raising your monthly investment by a fixed amount each year. It's almost impossible to overstate the power of this annual increase. Consider two investors who start investing $500 a month at age 25. The first keeps that $500 contribution the same for 30 years. The second increases their contribution by 10% every year. Both are in the same 10% average annual return. After 30 years, the first investor has put in $180,000 out of their own pocket and grown their portfolio to roughly $1,100,000. Not bad at all, they turned it into more than 6 times what they put in. But the second investor, who increased their contribution by 10% every year, put in roughly $340,000 and grew their portfolio to roughly $3,200,000. That's nearly 3 times the wealth from the same starting point, just by increasing contributions every year. The annual increase does 2 things at once. First, it puts more raw material into the compounding machine, meaning more dollars experiencing that exponential growth curve. Second, it aligns your investment contributions with your income growth, which typically rises over the course of your career. If your income is rising while your investment stays flat, you're actually investing a smaller percentage of your earnings over time. The annual increase keeps your savings rate proportional to your growing capacity. Now let me explain why these 4 numbers work together to create something more powerful than any single strategy on its own. The 7-year minimum horizon gives compound returns enough time to start bending the curve upward. The 5-category diversification protects you from concentration risk and keeps you invested through volatility. The 3 emotional phases prepare you psychologically for the difficulties that derail most investors. And the 1 annual increase accelerates your wealth building while keeping pace with your income growth and offsetting inflation. Remove a single element and the system weakens seriously. Invest for 7 years but concentrate in a single category. A bad sector rotation can wipe out years of progress. Diversify properly but exit after 3 years. You'll never experience the acceleration phase. Stay invested and diversify but never increase your contributions. You'll build wealth more slowly than your potential allows. Understand the emotional phases but have no framework to manage them. You'll know you're panicking and still be unable to stop yourself. Let me make this clear with concrete numbers. You're 25 and you start investing $500 a month in a diversified portfolio. You follow the 5-category approach, and you commit to staying invested for at least 7 years, knowing the early period will feel slow. You mentally prepare yourself for the disappointment, irritation, and panic phases that will inevitably come. And you commit to increasing your monthly contribution by 10% every year. At 32, at the 7-year mark, you've invested roughly $60,000 out of your own pocket and your portfolio has grown to roughly $90,000. The growth feels modest relative to the sacrifice, but you've laid the foundation. At 35, your portfolio has grown to roughly $150,000. At 40, you're around $350,000. At 45, you're approaching $700,000. And at 50, you've crossed the $1 million threshold. Notice what happens to the annual growth as you go along. In your early years, your portfolio might grow by $5,000 or $10,000 a year. In your 40s, it's growing by $50,000 a year. In your early 50s, a single good year adds more than the entire value of your portfolio after 7 years of investing. This is the compound acceleration everyone talks about but very few people actually experience, because most quit before they get there. The Rule of 72 offers another useful mental model for understanding this acceleration. Divide 72 by your expected annual return and you get the approximate number of years it takes for your money to double. At a 10% return, your money doubles roughly every 7.2 years. This rule reveals why the first doubling feels so different from the ones that follow. If you start with 10,000, the first doubling takes you to 20,000, a gain of 10,000. The second doubling goes from 20,000 to 40,000, a gain of 20,000. The third goes from 40,000 to 80,000, a gain of 40,000. Each doubling adds more absolute dollars than the one before, even though it takes roughly the same number of years. By your fourth or fifth doubling, a single doubling period adds more than the entire value of your portfolio after 2 or 3 doublings. I also want to address the thing that stops many people before they even begin. The feeling that it's already too late. Maybe you're 35, maybe 45, maybe 55, and you still haven't started investing seriously. The compound math seems to be working against you, because you don't have 40 years for it to accumulate. Here's the truth. Starting late is dramatically better than never starting. Even at 50, with 15 to 20 years until traditional retirement age, compound returns can still grow your wealth seriously. The 7-5-3-1 framework works at any starting age. The 7-year minimum horizon applies whether you're 25 or 55. 5-category diversification actually becomes even more important when you have less time to recover from concentrated bets. The 3 emotional phases will come regardless. And the 1 annual increase matters even more, because you're trying to accelerate progress on a shorter runway. The biggest mistake late starters make is concluding that because they can't achieve optimal outcomes, they shouldn't try at all. Late is still better. Less than ideal is still an improvement. Progress from a disadvantaged starting point is still progress. The 7-5-3-1 rule isn't a guarantee of any particular outcome. Markets fluctuate, economic conditions change, and individual circumstances vary enormously. What it offers is a framework for thinking about wealth building that raises your probability of success by addressing the real reasons most people fail. Most people fail not because they couldn't earn adequate returns, but because they quit too early. Most people fail not because diversification doesn't work, but because they concentrated in the wrong thing at the wrong time. Most people fail not because they're emotionally weak, but because they weren't prepared for the normal emotional responses to investment volatility. Most people fail not because they couldn't save more, but because they never systematically increased their savings rate. Here's what actually happens when you apply this framework and sustain it despite the inevitable difficulties. The first 2 years feel like you're wasting money. The third and fourth years feel like maybe it's working but slowly. The fifth and sixth years bring the first real doubt, shouldn't there be more by now? The seventh year arrives and you notice your annual gains starting to exceed your annual contributions. By the 10th year, your investment returns are producing more growth than your salary produces. By the 15th year, you stop obsessively checking your accounts, because the numbers are growing on their own. Somewhere around the 20th year, you realize you've built something serious. Not because any single year was extraordinary, but because ordinary returns compounded over ordinary stretches of time produced extraordinary results. The tortoise beats the hare not with speed, but with persistent forward motion. The people who build real and lasting wealth aren't the ones who found the perfect investment or timed the market flawlessly or got lucky on a speculative bet. They're the people who understood how compound returns actually work, who prepared themselves for the psychological challenges that derail most investors, and who stayed invested long enough for the math to deliver the results it promised. Compound returns feel slow up to a point, then that feeling reverses completely. The 7-5-3-1 rule tells you exactly why it feels slow, when it starts to accelerate, and what you need to do to make sure you're still in the game when that acceleration arrives. The wealth you're building isn't visible yet, because you're still on the flat part of the exponential curve. But that curve is real, and if you're patient, it will carry you to that future you imagined.